Hello and welcome to the third lesson, and in this lesson we're going to be talking specifically about market structure. So let's get into it. And the fundamentals of market structure. First, what is market structure? And that's how the candles move, and the reason why they move that way is a market making higher highs, lower lows, or lower or higher lows. And the first fundamental of market structure is that price only moves for two reasons. Alright? Price will either move to your buy side liquidity or to your sell side liquidity, with the goal of trading above it or below it. So if there's buy side liquidity and you're expecting price to go higher, the reason that price could go higher and where it's gonna go will be to that pool of buy side liquidity. And the second reason is that price is moving to fill an inefficiency in the market. And there are also four ways that the market moves. These above are the two reasons, and now I'm going to explain the ways that they move to reach those reasons. The first way is that market is expanding. Second way is that market is retracing. Third way is that market is reversing. And the fourth way, market is in consolidation. Market is consolidating. So let's get a deeper dive into what all of this means. The run on liquidity. Alright, so when we say there's a run on liquidity, what's meant is that price traded below sell stops, and those sell stops were made either from a swing low or equal lows. And when price trades below those lows or that swing low, that's price taking out the sell side liquidity in the market. And buy stops would be in the other way. So buy stops are created either from a swing high or an equal high, and when price trades above that point, that's price taking out the buy side liquidity. So as you can see in this example over here, these equal lows, and this swing high over here, and these equal lows make it perfect for sell side liquidity. What I mean by this is definitely there's sell side liquidity here because we're seeing these equal lows and we're seeing a couple of swing lows. So definitely we know there's sell side here. Price goes up, creates a swing high and equal low and equal highs. So that's our buy side liquidity. Now if we're bullish, what you would expect is market to trade below these equal lows to get the liquidity into the marketplace before trading up higher and targeting this buy side liquidity. And the reason that the market does this is because market knows that under these lows are going to be either trigger orders or sells or the protective stops of those going long. So price will go out of their way to come down and hit that level, and once that level is hit, the money from the stop of the traders who went long is now in the market, and those who had a limit order going short here, their money is now in the market as well. So that's where the liquidity comes from. So now there's money in the market, price will expand to the buy side liquidity, because that's the next option, because the market only moves for two reasons, and one of them is from liquidity to liquidity, and the other is to fill an inefficiency. So there's only two reasons the market moves. So once you can understand why the market is moving, it becomes very easier for you to actually predict what's gonna happen next. Okay, and let's see what's next. Consolidation. When market is consolidating, that means that we are in a sideways market with no one-way directional bias. So this is when price is staying at the same equal highs and equal lows and bouncing in between them. So when we see this happening, it's called consolidation. When price is just bouncing around in the same range, not really making much of a move. So what's happening during this time is that there are a bunch of orders going both long and short are accumulating. So under these relative equal lows, there's going to be a lot of protective stop losses from those going long, and there's gonna be lots of limit orders going short if price broke below this. And the same thing happening up here. Above these relative equal highs, there's going to be lots of protective stops, those going short, and there's going to be a lot of trigger orders which are going long. And obviously the market knows that this is what's happening, so price will typically make a run above the buy stops, then below the sell stops, and then the market will go in the direction of bias that it's meant to go in. So typically, if the bias is bullish, what you would like to see is price first make a run above the buy side. So first price goes up, and then once it takes out the buy side, it will come back down here, taking out the sell side. And once it took out the sell side, that means both liquidity from the buy side and the sell side is in the marketplace, and now would be the perfect time to send price higher because your bias is bullish. And let's go on the chart so I can show you an actual example of this. And obviously, as you know now, time frames make a huge factor on what's going on. So yeah, let's stay at the 4 hour. Over here we see an area of consolidation, and let me just mark it out. So these are the highs, this is the lows. Okay, so what we see here is this: price is consolidating, price wick down below here, taking out the sell side liquidity. So now the sell side liquidity is in the marketplace, and price just kept on trading higher until it had a clean bodily break over these highs, because this was just a wick high, came down fast. Maybe it just wicked high to fill this inefficiency before coming down really quick. And price was just kind of moving slowly, and because of all of these equal highs here, there was another pool of liquidity which is untouched. So what price did, price came back down, took out this pool of liquidity here because of the swing by this, and then went all the way up, taking out this liquidity here. So let's go in smaller time frame so you can actually see what I'm talking about. You can not see, so you can better understand. Alright, let me mark this out. First, all of this is called an inefficiency. You don't need to know the reason for now. You're gonna learn it soon enough. But just keep this in mind. This is what we mean when price is moving. Price is moving to fill an inefficiency. So this is our area of consolidation. Over here we have the buy stops. Over here we have the sell stops. Let me buy stops, keep this dollar sign, and sell stops. Change the color so you can understand. Right, so, and our bias is that, no, I'm not sure we have a bias right now. Market's just in consolidation. So this is the area of consolidation with the buy stops and the sell stops. Price over here, wick below, taking out the sell side liquidity in place, which added money into the market. Then once that happens, there was a bunch of traders who went short over here because they seen a break below these lows. So, and they would keep their stop loss here or here, most likely here, because it's above. They keep their stop loss at a recent high. So price will takes out the liquidity, traps the traders in the trade, and sends price higher, taking out this buy side liquidity and filling this bearish inefficiency. So once price came to fill this inefficiency, price will have to trade back down and just simply go up and down, up and down. And what we see here is another form of sell side liquidity because of the equal lows. It's just more recent, so it's just more short term. Price came here, and then price took out this sell side, And then, so after it took out this sell side, what would the next logical area be? At these equal highs. Go up, put a buy stops, make it buy, here are the buy stops. Price traded below this liquidity, getting the money into place. And then once that, what's the next pool of liquidity nearby? Would be these equal highs over here. Price traded all the way up there, taking out the buy side liquidity. Then market again went into consolidation before trading lower. Okay, let's see what's next in this expansion. And expansion, it sounds basically like, it is basically what it sounds. And that's when the market is expanding. That means market is repricing in one direction heavily. So if we're having a bullish expansion, that would mean that price is expanding to higher prices. And the bearish expansion would mean price is expanding to lower prices. And price expands in line with the bias. And as mentioned earlier, price is only expanding for two reasons: either for a run on liquidity, or to fill an inefficiency in the market. Next thing is retracement. So when price is retracing, that means price is going the opposite direction of the expansion to fill imbalances or to make a run on short-term liquidity. Each shaded area is a retracement in price. Key fact: price always moves for a logical reason, and this is very important. The way that the market is built, it's built upon a certain amount of rules, and the chart has to follow the rules. It has to take out liquidity before making a move, or if there's an imbalance, price has to go to fill it up before continuing with the movement. So when price is expanding in either direction, a retracement at some point is always expected. So let's say price is going all the way down like this, and you're thinking to yourself, oh my god, the market's crashing, let me get short here. But why would you get short over here? Market already moved all of that. Price eventually has to come back up to retrace. So it has to offer price to the upside, not only to the downside, because the market goes down and up, or up and down. It's not just gonna go straight flying. So that's why the price eventually has to retrace. Let me show you expansion and retracement actually on the charts. Okay, let me go to the 4 hour. Let me clear all of this for you. Alright, so this over here is what we would call bullish expansion. All of this, right? So this is our bullish expansion. This price is heavily repricing higher. It's just going one way up. So that's why that's our bullish expansion. And then this part here would be our retracement. And everything links together. So just change the color of this. Let's go down to the 1 hour. So what do we see here? What we see is price had this initial expansion all the way to the top here, and then price retraced at a certain point. Price retraces, and typically you can predict where the expansion is going to end. There's usually a reason for it. So let me just quickly check. So price, if you look to the left of the chart, and looking to the left of the chart literally means look to the left of the chart. Look to this side. What's going on here? Did price make a run on the liquidity? Did price do this or whatever? You need to look to the left because that's how you gain data. This is all information that is useful for you to find your setup, to find your entry, and to be profitable in trading. You need to have, basically, I want you to imagine trading as a big puzzle, as a huge puzzle actually, and with every little concept that you're gonna get taught, it's all a piece. It's all like a piece of the puzzle. And once you put everything together and you fully get a grasp of everything, that's when you can begin to see improvement in your trading. But the first step of actually seeing that improvement in your trading is understanding, and not just understanding, like really understanding the reason behind the market structure and understanding the basics of what's going on. Because trading, it shouldn't be too complicated. It is complicated, let's be honest, but you have to find a way to simplify it down as much as you can so it's easier for you. And that's what it is. You need to find something which is what you're learning now is hard, definitely, but you need to find your way to make it easy for you to understand. So over here you can see liquidity here, liquidity here. The price here traded above the bodies of the candle, and the bodies of the candle carried the most weight. So price went up, took out the buy side liquidity. So once price took out the buy side liquidity and we have a bullish expansion, what's next is that price is going to retrace. Price is going to come back down to fill any inefficiencies and take out some liquidity on the way if there is. So let's go back. Now we're on the 15 minute. Where is it? Now we're on the 15 minute. So let's see what price did here. Okay. Over here, price took out the buy side liquidity. Let's just make a line. Buy side liquidity taken from the left of the chart. Price came down for a retracement. Went back up, came down a little bit, took out this sell side here when it went down. The next thing would be where to take out this buy side here. Price came up, went back up to take out the buy side and to fill this inefficiency here. This candle is inefficient, so price took out the buy side, filled the inefficiency, came back down, then price went up one more time before fully going all the way down, wiping out all of this liquidity, taking this out. Then price consolidates a bit because it was a bit of a strong move, so it's going to take some time to accumulate more orders. And then price again, what happens if you look closely on this consolidation, before price delivered prices lower, it took out the buy side liquidity here. So as you see, all of these candles high are at the same point, so that's where the liquidity is. But eventually price just went up like this, taking out the buy side before crashing. And even if you look close right here, it took out this very short term sell stops, the sell side liquidity, before taking the buy side. So it really is a pattern in this. Price came here, took out the sell side right here, the short term sell side, went back up, took out the short term buy side, and that was all before offering prices lower till where? Let's go to the hourly so I can show. Price went all the way down till where? Till this, and this is called an order block. And don't worry, you'll learn more about it. Just keep this in mind. This is an order block and it's a bullish reference point. And that means when price comes back down to it, we're expecting price to continue with the bullishness. We're expecting that the retracement is now complete and it's time for the market to expand. So we expect here to go long. You can catch all of this. Excuse me. Even more if it holds. So that's bullish expansion and retracement and how it's used with the liquidity. And I hope you're really starting to understand how the time frames work and the importance of the liquidity on the time frames, and understanding that the bigger time frames hold more weight. So if on the daily it's looking bearish, and then you drop down to the hourly, you should expect to find bearishness with like in line with the daily, and then go to the 15-minute. So let's go back to the slides, and a reversal. And when price is reversing, that means the bias has now switched due to the circumstances. Each shaded area is a reversal in price. The reversals are engineered to happen at certain price points, usually after taking liquidity in the marketplace. A bearish reversal is when the uptrend gets disrupted by a strong bearish move, and the bullish reversal is when the downtrend gets disrupted by strong bullish move. And uptrend and downtrend, and basically uptrend is that price is bullish, price is trading higher, and the downtrend is price is trading lower. So a reversal would be that price is currently bullish and the bias is bullish, so price is trading up, but then after a certain price point, let's say price took out a recent buy side liquidity when our bias is bullish, and after it took out the liquidity, the market repriced heavily lower to attack maybe a swing low. That would be considered a reversal, because the price is no longer looking to trade higher, because it already traded higher, and it did what it needed to be done. It took out the liquidity in the market, and the price doesn't just stay there for no reason. Once it's done what it has to do, is going to go straight to the next. It's a computer, remember, it's all logic. It's just like a step-by-step process. Let's see what's next. And then we have the bullish market structure. So when the market bias is bullish, what you would expect to see is higher highs and higher lows. What that means is that there will be higher swing highs and higher swing lows with each expansion and retracement. So over here you see this is our initial range from this low to this high, and what a range is, it's just between two swing points, the distance between two swing points. So this would be our range. This is our low part of the range and our high part of the range. So you see price retraced back down, and it didn't break this low, it made a higher low, and then after made the higher low with this swing low here. So this swing low is higher than this swing low basically. Then price traded higher, and this swing high is higher than this swing high. Then price again retraced a bit lower, and this higher low, this swing low here is higher than this swing low. That's why it's a higher low, and that's why it's a higher high, because it's physically higher. Same thing here, higher high, higher low, higher high, higher low over here. And so when you're seeing the structure, that means you're clearly bullish until you see a reason not to be bullish. And the reason why it's important to understand the market structure, because this is how we're gonna get the best probability of understanding what price is going to do next. We're going to be able to understand where price is reaching towards and which way it wants to reach towards it. So if you're bullish and there's a bunch of buy side liquidity nearby, you would expect price to retrace a bit and then maybe take out a short term sell side liquidity before going all the way up and taking that targeted buy side liquidity. And the trader's goal is to identify the trend that the market is in and find an opportunity to get in line with the market. Because remember, the market knows where it's gonna go already. The market is gonna go to that price, and no matter what happens. So your goal, you need to identify first, is are we bullish, are we bearish? Is price gonna go higher, is price gonna go lower? And once you find evidence that price is gonna go higher, you need to find times where you can get in line with price going higher and not just wait. That's what it is. And you can't be always like price is going high and now it's just gonna crash. That's not how it works. You need to see something which gives you the thought of thinking now it's time to look the other way. So it's bullish until it's not bullish. That's what I'm trying to say. And this is the bearish market structure, and it's just the opposite. So when the market bias is bearish, what you would expect to see is lower lows and lower highs. And what this means is that there will be higher swing highs and higher swing lows with each expansion and retracement. So by now you know what an expansion and retracement is. There'll be higher highs and higher swing lows. So, and then prices here is expanding lower, and then price is retracing higher, price expanded lower, price retraced higher. So as you can see, each low of the expansion is lower than the last. So this expansion's low is higher than this expansion's low. This expansion's low is higher than this expansion's low. So each time there's a new expansion, the low is getting lower. So lower low. And same thing here with the high started from here, then price expanded, and on the retracement the high is lower than the first high, so it's a lower high. And same thing happens again. Price expanded lower, retraced higher, and the top of the retracement higher is lower than the previous retracement higher. And that's the structure that the market would move in if we're bearish. So let's go into the charts and let me explain to you reversals and the market structure. Okay, so let me show you the bearish market structure, how it would look like. So I mean the bullish first. I'll show you the bullish market structure first, and then the bearish. So this is how it would look like if it was like, if it was just drawn without the candles. See, bullish expansion, retracement, bullish expansion, retracement, bullish expansion, retracement, bullish expansion. So this is basically how the bullish market structure looks like. So this part here is our expansion. This is also expansion. This is also expansion, and this is also expansion. Okay, and then we have our points of retracement. So from here, I'll give you a second, point to where the retracement is happening. Okay, I think that's enough time, and I hope you figured out the retracement is happening here. I think it's not fitting. You know what? I'm gonna highlight the retracement instead to make it more clear. Change this ugly green color, make it yellow or orange. Yeah, orange is nice. Retracement here, retracement here, and retracement here. So in a bullish market, what we would expect to see is higher highs with each expansion, and a higher low with each retracement. So what does that really mean? So let me make it clear to you. This is our low, right? and over here is our high. This is the initial range of the bullishness from this low to this high. So then price retraced down here, maybe took out some sell side, some short-term sell side liquidity, or came down to fill an imbalance. That's the point of the retracement. And then so the retracement, the low is higher than this low. So this is what we call a higher low. Simple as that. It's just simply a higher low. And then take the high, copy paste that, put it here, higher high. And the reason this is a higher high is because the swing high over here is lower than this swing high. So the newest swing high from the newest expansion is higher than the previous swing high made. That's what it means. That's why it's called the higher high. And then same thing, price retraces to fill an imbalance, and then the swing point of this low from this retracement is higher than the previous swing low from the previous retracement. So it's a higher low. And I think you get the idea for this one and this one. So would this be a higher high or a higher low? I hope you guys said higher high. And this, would it be a lower low or a higher low? It'd be a higher low, because the low is simply higher than the previous low. So let me just put that in words. With each expansion, we're looking to see a swing high which is higher than the previous swing high made by the latest bullish expansion. And the reason that we would want to see that is because price is targeting the recent buy side liquidity, because as we know, each swing high has buy side liquidity above it, and each swing low has sell side liquidity below it. And with each retracement, we would want to see price trade down into the most recent bullish expansion, and we would likely find that price is retracing to either take out some short term sell side liquidity which was made during the expansion, or price is trading down to fill any inefficiencies in the market caused by the expansion. And oh my goodness, I spelled inefficiencies extremely wrong. It says it's unknown. Doesn't even know what it means. It's alright. I hope you guys know what it means. So this is basically how the bullish market structure works. Alright. Bullish market structure. So now we know the bullish market structure. Let me have a deeper analysis into the bearish market structure. So bearish market. So the way it would look is like this. Let me find the brush. We have our low, we have a high, lower, retracement, lower, retracement. I hope you guys are getting the hang of it now. So I'm gonna just give you guys a minute to point out where are the expansions, where are the retracements, and where are the higher highs. Sorry, where are the lower lows and the lower highs. Okay, I hope that's enough time. So let's just mark it out. In the beginning, you would need to mark it out so you can actually just see what's happening. And once you have done that for some time, it's just gonna become second nature to you, and you're just gonna see it happen all the time. So this is our low, this is our high, this is our initial range, and we see price trade lower than this low, making it our lower low. Lower low. Same from here, price traded down, making the lower low, retraced back up, beautiful inefficiencies, but all we care about is that the high is lower than the initial high, so it's a lower high. Same thing happening again, price is expanding lower for retracing higher, and the low of the new expansion is lower than the low of the previous bearish expansion, so it's a lower low. And the retracement's high is lower than the high of the previous retracement. And this is basically what we're looking to find in the bullish market structure. We're looking at each bearish expansion's low is lower than the last bearish expansion. That's what we want to find within each bearish expansion. And the reason is the same reason for the bullish market structure. The reason is price wants to reprice lower, so it's going to target the recent sell side liquidity. Because as you know, between each swing point there's going to be liquidity. So under this low there's liquidity. So price came down, took it out, traded back up, fill in some inefficiencies. So this swing low here would be sell side liquidity. Price would go up, fill the inefficiencies. Where would the next target be? Below this sell side liquidity. Price is going to trade below, retrace higher, and where's the next target? This sell side liquidity, like that. And just keep going down, attacking recent sell side liquidity. And that's why the market structure looks like this. Because if price was to break this high like this, that is a shift in market structure. And I'm going to talk about shift in market structure in just a second. But that's just why the bearish market structure is like that. Why the highs aren't higher and they're lower. It's moving in sync like this. So in each retracement, so basically each retracement is an opportunity for us to get in line with the current market structure. with the current market structure. Because if you think of it, we need to see a low get violated before the idea comes into our head that the market is bearish. So once we see this low get violated and price retrace back up, we could enter short here, take profit somewhere around here. Once this liquidity has been hit, price will retrace back up, we'll go short over there, take profit where this liquidity has been hit. And that's the cycle we're looking for. And that's why understanding the market structure and making sure it's in line with your bias is really the key factors to finding good trade setups. So now I just want to talk about what a shift in market structure is, because I already told you about reversals, but how do you know that price is going to reverse? And this is how. So this is a bearish shift in market structure, and that's when there is a bearish displacement taking out a pool of sell side liquidity or a swing low. And the displacement is this shaded area. As you can see, these couple of candlesticks were all red and they were all pretty strong down. So that means that price has a desire to take price, that the market has a desire to take price lower, because it's using all of this strength, all of this power to send price lower. Doesn't want to send it higher, it's purely focused on sending it lower. And we know that because these sell stops over here got violated with a strong move. And that's what a displacement is. It's just a strong one-sided candle. And when you see a strong one-sided candle, and it's not necessarily one candle, could be two or three, but they're all strong and they all follow the same idea. So when we see a displacement taking out a key level, key area, such as, pool of liquidity or a swing low, that means price is gonna continue in that direction. So in this example, price took out the sell side liquidity. That means price is gonna be bearish as the bias. That there's a bearish shift in market structure because we've seen this. So once we've seen that displacement taking that out, we would start to think bearish. So now we'd expect price to attack lower liquidity points. And obviously before expecting a bearish shift in market structure, we'd like to see price trade taking out buy stops or buy side liquidity, or price to trade into an imbalance or an inefficiency before sending price lower. And as you guessed it, there's also a bullish shift in market structure, and it's just the same concept. A bullish shift in market structure is when there's a bullish displacement taking out the pool of buy side liquidity or a swing high. In the example, the shaded candles is our displacement taking out the key area. So as I mentioned earlier, this strong bullish move taking out this key area would give us a bullish shift in market structure. So when we see this strong move, that's when we begin to think that the market is bullish. That's when we begin to look for retracements before we go long in. So obviously before the bullish displacement, we expect price to take out a recent pool of liquidity before offering price higher. So let's actually go in the chart to put all of this to the test. So let's go here. Let's change from this actually. Remove the drawings. So let me find you a bearish shift in market structure. And one thing which is important, the bearish shift in market structure is for all types of time frames. For example, if you see a bearish shift in market structure on the daily, that means you can expect the next couple of days or weeks to be in that direction. Meaning if you see a displacement taking sell side liquidity on the daily, you would expect price to follow in that bearishness for the next couple of days, or until price is no longer bearish because you've seen something which turned it bullish. So in this example, what do we see? Over here, swing low, bunch of sell side liquidity, price took it out with this displacement here, and after it took out the sell side, what did price do? Price came up, taking out this buy stop liquidity here, this buy side liquidity. So first, price gave us the bearish shift in market structure when it traded strongly below this point. So once we seen, I'm gonna write this down. Once we seen price trade below these sell stops with a strong essence, you would get our bearish shift in market structure. MS is market structure. So price took out this, and gave us the bearish shift in market structure. So once price took out this key area, the next logical thing for it to do would be to take out the buy stops over here. Let's go in the 4 hour so you can actually see how it looks like. You see, bunch of liquidity over here. Price traded up with an urgency to take out this buy side liquidity. And now what you're probably thinking is, this is also a displacement, and it took out this high. Why are we not bullish? It's because we just got our bearish shift in market structure from the daily. So what's happening in the smaller time frames on this 4 hour is price is just going to make a run on liquidity. It's not gonna change, because on the daily, which is a bigger time frame and it holds more weight, we confirmed that the market is bearish. So price would go up to take this, would take out the buy side before going where? Surprisingly, very surprisingly, price came all the way back down to take out the sell stops made before price went up to take out the buy stops. So you see, these sell stops were made, and then price went up taking out buy stops. So price went up here, where we had the traders trapped. Some were going long, some just got stopped out, and it doesn't matter what happened. So now there's money in the market because of that. So then the price will go look for recent equal lows or recent swing lows, because we're bearish. So that's what the market structure would do. So from here, took out the buy side, will come all the way down, take out the sell side. Price might have a little retracement up before coming all the way down here, and then same thing happening here. We'd have our buy stops here. We change this to red, and sell stops here. What happens is price trades above these buy stops, taking out the buy side liquidity in the marketplace, and to fill this bearish inefficiency over here. So now we have two things happening at the same time. Price took out the buy side liquidity, price is filling a bearish inefficiency. So both of those things, plus that the market structure is bearish on the daily time frame, all of those three things put together is what's reassuring us that the market is actually bearish. So all of that happened, and look what happened next. Price trades taking out these sell stops below. Let's even drop down to 1 hour to get even the finer details of what's happening in the market structure. And this is what you need to do. It's what you need to practice. Understand why market is doing what it's doing, starting from a big time frame and just dropping down, just to see exactly what's happening. So as you can see, took out the buy side, came down, took out this sell side over here, because there was sell side due to this swing low. Price took it down before it went back up here to take out this buy side. So that's why so basically this is the area of consolidation, right? And then price came, took out the buy side, first thing here, then came down, took out sell side, went back up, took out the buy side again, and price traded all the way lower, taking out the main sell side liquidity. Price had a little retracement back up here. This is all just to fill in inefficiency. That's why price traded all the way up here. And if you look at the way that price traded, what do you see? First, you'd see here a little area of consolidation in this square. Price traded above the buy side, and then this is the sell side liquidity over here. Price went up, created this buy side liquidity with these equal lows, these equal highs I mean. Went down, made the sell side with these equal lows. Price went up, taking out the buy side, before price comes back down to take out the sell side made here by this wick here. And price is also here at the breaker. You don't know about breakers yet, but just this is a breaker block and will give us the extra confluence needed to go along and catch these 60 pips. So the next target would be after price took the sell side, would be for price to come back up here to take out the buy side. Going back up, took out the buy side. Once took out the buy side, it's at the bearish order block, giving us the bearish confluence. So where is the nearest sell side? Not the nearest. Where is the most logical approach for sell side? Knowing that market structure is bearish. So knowing that the market structure is gonna go from low. So point this out. This is our high, and this is our low. And we know that market structure is bearish. So they expect price to go up, take this buy side liquidity here, and create a lower high, and which it does. So once we see this lower high over here, we can begin to go short, and thinking that price is gonna do what? Make a lower low than it did the time before, because this is the low. So price will go from high to low to create a lower high to making a lower low. And here we have it, a lower low. And same thing happening again. Over here, there's a buy side liquidity. Price goes up, takes out the buy side inefficiency. Price comes down, takes out this sell side, goes back up, takes out this buy side here, before price trading down. And so what we see here from this low to this low, it's also a lower low. So our bearish structure is still intact. It's still there with us. And the high from this high to this high, it's a lower high. Here is a lower high. So all of this is telling us that we are still bearish. So we need to see something which makes us not bearish, right? We'll go back to the 4 hour. So same thing here. This high just went up to take out this buy side and to fill this inefficiency before taking out the sell side. Same thing happening here. Price going up, and we first get our bullish shift in market structure with this displacement over here. As you see, price came here, took out this sell side liquidity, so there is money under here. Price came and took it before trading very strongly upwards above this high, above this buy side liquidity. And what do we say when there's a strong one-sided move trading above key area? That's our bullish shift in market structure. So price trades up here, giving us our bullish shift in market structure, retraces back down and goes up. Now let's check in a smaller time frame this retracement, what's actually going on. Okay, it's over here. So if you can see what's happening, price took out the sell side, then one traded higher, taking out this buy side. On the 4 hour, this was here, this was just a wick. Took out the buy side, came back down and retraced to filling these inefficiencies before trading higher, targeting this high or this high. and price comes back down, making sell side liquidity here. These equal lows. Price takes out the sell side liquidity before trading higher, taking out this buy side right here. So what this just showed you right now is how the bearish market structure actually works over here with the lower lows and the lower highs, and how it takes out the liquidity before creating an expansion or a retracement. And over here is how we see our shift in market structure and actually a change in bias. So up till this point, we are bearish until we see this shift in market structure. So this is we're bearish, this we're bearish. Then price came down here, we're still bearish. But once we seen price trade all the way up here, taking this high out on the 4 hour, that's it. We're now bullish. The market changed, and as you can see, the market really did change bullish from there. It's bullish all the way here until we seen a bearish shift in market structure, and we seen the bearish shift over here. So let's take a closer look into how the bearish shift of market structure actually is. Okay, so what we see is these are these equal lows here, and this is the equal lows here. You can pick either one. Price came here, price came here. You see a strong one-sided candle bearish, and that is giving us our bearish shift in market structure. And that means we are bearish until we hit a certain price point, which is typically a large pool of sell side liquidity, or to fill a large inefficiency, or we see price just turn bullish. That's how we know that we're now bullish instead of bearish. But because of price traded down with this bearish displacement, we're bearish until we see a reason not to be. So as you see here, swing low, you know a swing low what that is already. Sell side liquidity over there. Price trades back up here, fills an imbalance at the order block, trades down, targeting this first. That's a lower low, higher high, lower low, higher low, sorry, lower low, higher low, and the same thing, same thing. Now let me show you how bullish market structure looks like. And that's the last thing today. So this would be our low, and this would be our high. And if you remember, in bullish market structure, we're looking for a higher low and higher highs. So what we see is, this is our initial range. Price has its retracement here, creating us a higher low. Higher low compared to this low, because you know it's higher. And price tried to go trade back up here, but didn't create a higher high, so we wait. We're not bearish yet because there's no shift in market structure bearish, so we're just being patient. Price comes back down, trades higher, takes out this liquidity here with this swing high before trading lower, taking out this sell side liquidity. Now this is the buy, and then we see price trade higher over here, creating a higher high. Higher high. Price again retraces into this displacement, and what's it making over here? A higher low. Higher low. And if you noticed, price didn't necessarily make a higher high over here, but it did make a higher low. So we're still bullish. There is no reason to think that we're bearish. Same thing happens. Price goes up here, taking out the buy side liquidity. That gives us a higher high. higher high, price traces a bit this swing, giving us a higher low, and it's just targeting pools of liquidities and filling inefficiencies. That's what the market is doing in the structure. And I hope you learned a lot this lesson, and thank you.